Have you ever wondered why the stock market, which seems so logical and data-driven, can suddenly go completely haywire?
Why do prices plummet, fortunes vanish, and panic fill the air?
The answer isn't just in the numbers. It's in our heads. Today, we're diving deep into the psychology behind every market crash. This isn't about predicting the next one, but about understanding the timeless human emotions that drive them: fear and greed. By the end of this video, you'll see the markets in a whole new light. Cut to a simple animation showing a seesaw with greed on one end and fear on the other. At its core, the market is a giant pendulum swinging between two powerful emotions, greed and fear. Let's start with greed. When the market is going up, it feels fantastic, right? Your investments are growing, news headlines are glowing, and your friends are talking about the money they're making. This triggers a classic psychological phenomenon: FOMO, the fear of missing out. You see others getting rich, and your brain tells you, hey, I want a piece of that. People start buying not because a company is fundamentally sound, but because its price is going up. This is pure greed talking. It creates a feedback loop. Rising prices attract more buyers, which pushes prices even higher. Logic and caution get thrown out the window. We start to believe this time is different. We tell ourselves that the old rules don't apply. This is the fertile ground where a market bubble begins to inflate. Think about the dot-com bubble in the late 90s. People were pouring money into internet companies that had no profits, sometimes no product, just a com in their name. Why? Greed and the belief in a new economy that would go up forever. It felt like an endless party. But what happens when the music stops? The seesaw animation now tips heavily towards greed, looking very unstable. This phase of irrational exuberance is what we call a bubble. Asset prices become detached from their intrinsic value. It's like blowing up a balloon. It keeps getting bigger and bigger, but the rubber is getting thinner and thinner. Everyone inside the bubble feels like a genius. They mistake luck for skill. They borrow money to buy more, taking on huge risks because in their minds the only direction is up. But here's the thing about bubbles. They always pop. It doesn't happen all at once. Usually there's a trigger. It could be a piece of bad economic news, a major company going bankrupt, or a sudden change in interest rates. It's something that just plants a tiny seed of doubt. This is where the pendulum starts its violent swing towards the other side. Fear. The animation shows the bubble popping and the seesaw slams down on the fear side. Suddenly, a few smart or lucky investors start to sell. The price dips slightly. At first, many people ignore it. They think it's just a small correction. A correction is a healthy, normal part of any market cycle, usually a decline of 10 to 20% from a recent peak. It's like the market taking a breather. People who bought at the top might get a little nervous, but the long-term believers often see it as a buying opportunity. But in a bubble, this small dip can be the spark that lights the fuse. More people start to get nervous, the selling picks up speed. The news headlines, which were once glowing, now turn negative. Market tumbles. Investors lose billions. This is when FOMO's evil twin shows up, the fear of losing everything. This is where our primal survival instincts take over. The logical part of our brain, the prefrontal cortex, gets hijacked by the amygdala, our brain's fear center. All that complex analysis goes out the window, replaced by a single, powerful command: get out now. This triggers a cascade of selling. It's not about fundamentals anymore. It's a stampede for the exit. People sell good stocks, bad stocks, everything. They just want their cash back before it all disappears. This herd behavior is incredibly powerful. When you see everyone around you panicking and selling, it's almost impossible not to feel that same panic yourself. Your neighbor is selling, the experts on TV are sounding the alarm, and your portfolio is bleeding red. The pressure to join the herd and sell becomes immense. This wave of panic selling is what turns a healthy correction into a full-blown market crash. The balloon doesn't just deflate. It explodes. The prices don't just drift down. They plummet. The greed that took months or years to build the bubble up can be wiped out by a fear that takes over in just days or weeks. Look at the 2008 financial crisis. It started with issues in the subprime mortgage market, a relatively specific area. But once the fear spread that major banks could fail, the panic went global. People weren't just selling bank stocks. They were selling everything, terrified the entire financial system was collapsing. Fear became the only driver. So, how do you protect yourself from this emotional roller coaster? The first step is awareness. By understanding that these psychological forces of fear and greed are always at play, you can learn to recognize them in yourself and in the market. When everyone is euphoric and telling you that you can't lose money, that's the time to be most cautious. That's greed talking. And when everyone is panicking, when there's blood in the streets and it feels like the world is ending, that's often when the best opportunities are found. That's fear talking. As the famous investor Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." This means having a plan before the chaos starts. Know why you're investing. Are you in it for the long term? Have a diversified portfolio that matches your risk tolerance. Don't check your stocks every 5 minutes. And most importantly, don't make emotional decisions. If the market crashes, revisit your plan. Is anything fundamentally different about your long-term goals? Probably not. A crash doesn't change the fact that great companies will continue to innovate and grow over time. Understanding the psychology of crashes transforms you from a passenger on an emotional roller coaster to a pilot with a flight plan. You can observe the panic from a distance, knowing it's a predictable, if painful, part of the market cycle. You can see the bubble forming and resist the urge to jump in at the top. You can see the crash as the fearful selling of others, creating potential bargains for the patient investor. The market will always swing between fear and greed. Bubbles will form and they will pop. But by understanding the human emotions behind it all, you can navigate these cycles with wisdom and confidence, instead of getting swept away by the madness of the crowd. Thank you so much for watching. I hope this gave you a new perspective on how the market really works. If you found this helpful, please hit that like button and consider subscribing for more content that helps you become a smarter, more rational investor. Let me know in the comments if you've ever felt that FOMO or panic during a market swing. I'd love to hear your story. See you in the next video.